Welcome everybody. Now for those of you living under a rock or who actually have a life, here's a quick recap of everything that's been going on. Trump was like, I'm about to tariff that shit. The market was like, yeah, no you won't. Good luck, bro. Trump proceeds to tariff everything, the market. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks mostly fell on Monday in reaction to President Donald Trump's announcement of tariffs on China, Mexico, and Canada, but the major averages paired heavy losses after Trump said the US would delay tariffs on Mexican imports by a month, indicating that there are some terms and conditions and talking happening behind the scenes. However, it was still mostly red, reeling off a pretty brutal pre-market and futures open. Some stocks were down as much as 3%. However, there definitely was green, and anything that was heavily levered to Canada, China, or Mexico really took it on the chin. Anything within the domestic economy was actually pretty good. For example, look at Costco, up 2.47%. Look at Walmart, heavily levered to the US economy. They can absorb input costs. Now, they are also in the staple sector, and staples did outperform relatively speaking, along with healthcare services and communications. Now, these stocks, along with utilities, are actually all staple companies. So staple stocks, defensive stocks, definitely did outperform relatively speaking. And those stocks that underperformed with stuff like Tesla, right? This is pretty much consumer durables. It's all of the automakers. They were down in a very big way. Same to yield with technology. We do know that tech is extremely levered to China. That's why we saw Apple, AVGO, Nvidia down all in excess of 2%. Google was down as well. Same too with Microsoft. However, Meta was up 1.42%, and software as a whole was very resilient, all things considered. Now, Visa and MasterCard were up 0.78 and 1.27% respectively, and my portfolio is about 80% Meta and Visa. So my portfolio was actually very green today. And then we saw healthcare technology, a bit of a mixed bag. Some of the big names gained, some of the smaller names lost. Such goes the market, and then financials were mostly in the red. But ultimately, the biggest loser here today was XLY discretionary. And that's because Tesla is in this boat right here at all of the automakers. So discretionary was down 1.19%. Technology in second place from the bottom, down just over 1%. And then industrials, right? Again, heavy weighting to Canada, China, and Mexico. Stuff like Caterpillar. They have huge exposure in those geographies. And that's why we saw industrials down 0.93%. The S&P 500 as a whole fell 0.5%. But if you actually look, at one point, the S&P 500 was down at nearly 1.5% on the day. And some of these sectors like tech and the XLY down nearly 3%. So we actually did pair a lot of the loss when Mexico came to terms and Trump delayed those tariffs by a month. And look what happened right here, guys. This yellow line is actually GLD gold. So to open the day, when every single sector was in the red, gold was up 1.2%. Really goes to show that there was definitely safe haven and defensive buying, because we saw XLV, healthcare, XLU, utilities, as well as XLP staples. They were all here at the top. We also did see XLB materials, right? And again, buying stuff like gold and silver is sort of a hedge against tariffs, and they were down only 0.2%. Now it is green, it should really be red right here. And then the best performing sector was energy. Again, just a bit of an inflation hedge right there, because tariffs are inflationary. I talk about why in the macro portion of this video. So skip to the macro portion and explain how and why tariffs are inflationary. And commodities are simply, and that's why we saw XLE energy as well as the material sector a little bit more resilient than the rest of the market as a whole. And it really was a risk-off day today. Now we can see a large cap value, which is just defensive sectors, was up 0.08%, relatively speaking, very resilient. And what really took it on the chin today was high beta. I mean, in a market liquidation like we really saw at the start of today's session, you're going to sell small caps. You're going to sell these high beta stocks with a lot of debt on their balance sheet. And that's why we saw small cap value, which is like a lot of like regional banks, biotechs, is down 1.34%, as well as a small cap core down 0.94%. Mid caps kind of hanging in there. Mid cap growth was just on the flat line. We saw mid cap core sell the most, but they were largely resilient, all things considered. But the market really did put a weighting for some reason on large caps. They did do a little bit better than small caps, and to a degree mid caps as well. Either way, the place to be today was in that mid cap and large cap components of the market. And globally, things were very, very red. Not a green in sight. North America, very red. Same 2 year with South America. Asia as well. India, China, Southeast Asia. Australia was deep in the red. I think our market was down 2%. And then Europe was very red because Donald Trump came out and said Europe is next on the tariff front. Now, all of the selling came on the back of what we already know. And you guys already know this if you're watching this video. Trump came out and put a 25% tariff on Canada and Mexico, 10% on China, and then Canadian energy imports will only have a 10% duty. So that was the news over the weekend. These tariffs are set to take effect on Tuesday. Trump announced them on Saturday. Futures opened very, very red. But the reason why we paired a lot of those losses is because Trump paused the tariffs on Mexico for 1 month while they agree to certain terms. Now, President of Mexico came out and she agreed to send 10,000 soldiers to the US border to stop the flow of fentanyl and illegal immigrants coming into the country. And that was Trump's terms. He just said, we want you guys to do your part on your side of the border when it comes to illegal immigration for both Canada and Mexico, because China, and so much so the rest of the world, uses Canada and Mexico as a backdoor to get their products in, whether legal or illegal, into America. So again, Trump having, America's best interest at heart. The markets as a result are going to be very, very wobbly. But I think, Trump maybe saw the reaction. And then when Mexico wanted to come to terms, he said, look, we can do this. Announced the agreement. He's going to pause Mexico's tariffs. The dollar came down. Yields eased as a result. And that's why we did see a great dip buying opportunity today. Now, we'll see if that has staying power into the rest of the week. Nonetheless, things are evolving very, very quickly with this Trump presidency. And so, guys, if you don't want to miss a beat, go ahead, subscribe, because I will always have the latest every single morning as quick after the close as possible. Now, what also did help stocks bounce off the lows today was that Trump signed an executive order to create a sovereign wealth fund that could actually buy TikTok. The president had previously floated the idea of US taking a 50% stake in the social media platform as a part of a deal negotiated with TikTok's Chinese parent company ByteDance, which has to divest itself from TikTok if it wants to escape the US ban, which could happen anywhere from 60 to 90 days from now. Now, on Monday, Trump signed an executive order directing the US Treasury and the Commerce Departments to launch a new sovereign wealth fund. He said that TikTok could be on the deal as well as a lot of other things. Now, pretty much I think that this wealth fund is just going to hold, liquid and investable assets, everything from bonds to stocks, maybe even private companies like TikTok. It really goes to show that Trump is really thinking about the markets, and we'll see how this pans out. I think this is a really, really good thing for the US market as a whole. Very surprising they don't have one, but we should see the sovereign wealth fund grow, especially the US equity markets. Very, very strong, very, very resilient. However, guys, in light of everything we saw here today, all of the volatility, stocks were down, especially stocks heavily levered. Canada, China, Mexico. Apple was down 2.92%. 30% of their business is in China, a lot in Canada, a lot in Mexico as well. Now, you did see them come off the lows, but still down nearly 3% from their highs coming off Friday. Tesla was down 5.17%. because Canada and Ontario came out and said they were going to not use Starlink. They're cutting their $100 million contract. And so Tesla took it on the chin. Automakers as a whole took it on the chin, down 5% on the day. But really, the stock should be at $200 after the earnings last week. Nvidia was also down 2.15%. Again, on the back of this tariff news, because 14 to 15% of their business comes from China. And who knows what Jensen and Donald Trump spoke about at their meeting on Friday. And rather than waiting for that news, the market just said, hey, I just don't want Nvidia, I don't want the risk. And then we also saw home builders down 2.41%. The market telling you that tariffs on Canada and Mexico are going to push up construction costs. That's going to have a tangible effect on margin, bottom line, maybe even top line. That's why D.R. Horton and a slew of other home builders down 2.41% on the day. And guys, it was terrible breath here today. Only 2,100 advances, 4,200 decliners. I think this is the second day in a row where we had 2-to-1 decliners to advances. The stuff we don't really want to see. However, when we look at net inflows, smart money was buying. We really did see net outflows here to end the day, but after the announcement of those tariffs, we did see flows move to the upside in a very big way. The S&P 500 did react initially, but as flows continued to make higher highs, the S&P 500 traded flatline. In other words, smart money was buying. There definitely were some sellers, but money was flowing into the markets today, guys. Regardless of what the actual nominal figure was, the S&P 500 down 0.46% doesn't actually matter because, again, smart money that really drives inflows really did move higher today. And that is a positive sign, especially when we saw this capitulation here to kick the day off. But all in all, when you look at longer term market momentum, we see that trends tend to be very, very shaky at the moment. There isn't a discernible trend. Shorter term trends, the 5-day, which is noisy. So let's actually just count it out. It is in the red. Only 31% of stocks above their 5-day moving average. However, the 20-day, we still have 50% of stocks above the 20-day. These medium term trends, the 50-day, 100-day, looking sketchy, but the longer term trend remains. In other words, any volatility we do get, buy the dip until these longer term trends actually break. We haven't seen them break. We still see some of the shorter trends looking very, very constructive. And we do know that the shorter term trends lead to the medium term trends. These should be incrementally positive, assuming we continue to see net inflows in the market, smart money buying, big money buying, and we do get the earnings and data we need for this week. If we can get that, medium-term trends should pull up, and this should be a boon for some of the longer-term trends. Either way, guys, if you're looking for opportunities in the market, look for stocks that are below their 50 and 100-day. As you can see, shorter-term trends slightly improving, relatively speaking. Now, coming from Friday, we did see a decrease, but still 20% of stocks above their 20-day moving average. So shorter-term things looking all right. Look for stocks in this vein, below their 50-day, below their 100-day. And then if you want to buy these stocks looking to break out above the 50% mark, that should bode well for longer-term trends. So opportunities do exist in the market. It's just that if you are going to screen for stocks on a momentum basis, this is what you want to look at. And maybe if a shorter-term focused 5-day as well. But let's hop on the charts. And guys, looking at the charts now, we see a very risk-off day across the board, particularly in small caps. The IWM down 1%. Now, do be aware the market is about 10 minutes away from closing, so the market is still open. But we did see the S&P 500 is currently down 0.6%. Same with the NASDAQ 100, and the RSP actually only down 0.35%. So we're seeing relative outperformance in the equal weight compared to almost every other segment of the market. Very interesting to see that trade happen right there. And very interesting as well to see, guys, look at this. The 10-year yield and the 30-year yield was actually down today. The 2-year yield was slightly up. So the market is actually pricing in a little bit of near-term inflation impact with the 2-year yield. But longer term, they actually say that it's very likely that the economic impacts of tariffs will outweigh the impacts of inflation. And that's why we actually saw these yields go down. So the market is telling you that it thinks tariffs are going to weaken the US economy. That's very, very interesting. The dollar was stronger. I guess that goes with the notion that we did really see a safe haven trade. Gold was up, silver was up today, the dollar was up, defensives was up. So we did see the market defensives move to safe havens, and we did see the TLT was up 0.4%. The AGG was down. So shorter term bonds down, longer term bonds up. Goes to show that, yeah, there was a little bit of safe haven buying in today's trade. So yeah, the market did get defensive, and that's because we did get a lot of high impact news. But, the market very volatile right now. We saw WTI down 1.37%, crude, and the nat gas was up 6%, but they're in a vein of their own, not really correlated to the market at all. But equities down, it was risk off. Bitcoin was actually up 4% here on the back of the sovereign wealth fund news. We do know that there's going to be a lot of Bitcoin in that fund, and Bitcoin very volatile today. Look at this wick, and that was simply the case for pretty much the entire market. We saw a lot of selling here initially, but it just proved to be a great dip buying opportunity. This wick really goes to show that there was very strong buying here in the Bitcoin market, in the crypto market as well. I mean, maybe not so much the crypto market, but definitely in Bitcoin. Looking at the S&P 500, and for those of you that don't know, these lines are the gamma flip lines. They indicate the options market positioning and how dealers hedge their portfolios to determine where the market will go. This yellow line is the gamma flip zone, This is the core wall. This is the put wall, also known as the put support or the core resistance. Long story short, in positive gamma, which is above the gamma flip, dealers buy dips and sell rips, and you generally get this type of price action. Very orderly upside with a lean to the bullish side. In negative gamma, dealers sell with the trend, and we tend to see dealers sell into weakness, buy into strength. You get very volatile price action. Either way, what we're really trying to do is buy opportunities into negative gamma and hold for us to get to the core wall, at least on a short-term focused view. This is anywhere from 1 to 2 weeks leading up into the OPEX. And you can see that very clearly right here. The second we got into negative gamma, we saw a lot of volatility. But the second the market started moving up, dealers went with the trend. And now we're sort of back in this positive gamma zone. In other words, this was opportunity to get long. Yes, we are still red on the day, but this was opportunity because we went into negative gamma, couldn't stay there for long, moved back into positive gamma. And now our end of week target is the 6100 area. In fact, this happened last week as well. If we just zoom in, you can see that we dipped all the way down to here on the DeepSeek news. And what did we do? We ended up at the 6100 area. And I think much of the same is going to come true this week, especially when we get a deal with Canada. I think that's going to happen. And we get more news with regards to earnings and data. I think we're going to get some pretty good earnings and data this week. A lot of the preliminary indicators are telling us that as such. So this was an opportunity for you guys to get long, at least in the week. And unless we actually get a significant escalation in tariffs from China, I would say, as well as Canada, then the market can go lower. But for now, buy the gamma flip. If we get below the gamma flip, right, and we fall below here, that's when things can get hairy. That's when we can maybe start getting defensive. But as long as we're in this positive gamma area and not in negative gamma, I think we remain optimistically bullish on the market in the short term, medium term, and longer term as well. We do know that earnings are looking very, very good. So I would say that this is simply an opportunity to buy the dip. And let's actually look at things realistically, right? Let's zoom out on the last year. What we actually see is that this is great opportunity. This right here is setting up to be a higher low relative to this low, which was a higher low relative to this low, relative to this, relative to this. So what we see is just, higher highs, higher lows, new all-time highs, very constructive price action. If you ask me, this is the type of stuff you want to see in bull markets. Now, the NASDAQ 100, very similar situation. We broke into negative gamma ever so slightly, and we bought the dip. Buyers bought the dip very, very aggressively. Remember, we saw net inflows today, and like last week, we probably go ahead and target the 2195 area. We haven't broken all-time highs just yet since late December in the NASDAQ 100. That's what I really want to see. I really thought we were going to go do that last week, but the DeepSeek situation happened and now the tariff situation, but it looks as if we are going to move, especially if we get Canada coming to the table and maybe even China. But China only had 10% tariffs, so I think we're going to see a more gradual play out there. China likes to play hardball initially and then they come to the table, whereas Mexico generally come to the table immediately. That's because China have more leverage than Mexico. However, China is in a deep recession right now, and they can't really afford massive tariffs on all their goods, particularly when it comes to technology and that sort of stuff. Now, this is the S&P 500 and the NASDAQ 100. In other words, we're still in positive gamma, and that means you buy dip, sell rips, aiming for the core wall. And in the NASDAQ 100, that's 21,915. In the S&P 500, that's the 6,100 area. In the RTY, we see some very interesting developments. Now we bounced right off the put support, extremely volatile, and now we're flirting with the gamma flip right here, okay? So what we really want to see to kick off this week is we want to retake this gamma flip and move higher from there. If we cannot do that, we probably move lower from here in the Russell 2000. So we did try to take back positive gamma. Bears came in a very big way at the highs. Bulls came in at the lows right here. So it's anybody's guess as to what happens next. But in negative gamma, we get very volatile price action, as you can see from the swings right here. And all you really want to do, guys, is buy any opportunity we do get at the put support. Unless we actually have a close below the 2200 area, then things can get very, very dicey. We haven't seen that yet. We're at the gamma flip. Let's try and break above and then go from there. If that doesn't happen, we probably move lower back to these levels, where we will then make our next move either to the upside or the downside. But when we get there, I will let you know. It's going to be a very volatile week for small caps. So guys, look, if I were you, I'm buying the dip in the S&P 500 or the NASDAQ 100, the RSP as well. It definitely looks like the most constructive out of all of the indices. I mean, it's setting up for another higher low. It's down the least today. We definitely are seeing that rotation. However, if you really are looking for safety, the mega caps are a pretty safe trade, especially with their software revenue. So I think the place you want to be specifically is the S&P 500 and the NASDAQ 100. Now, if you're looking for individual names, if you guys want to place some, PayPal is actually reporting earnings tomorrow. Now, PayPal was actually a 0.93% today, now 0.95, ditching the overall market. So this is a great name. It still trades at an 8% free cash flow yield, so very undervalued. And the management team are doing great things. I owe PayPal, I'm up about 70% in the name. For those of you that follow me in this channel, we were buying PayPal heavily in this channel right here. And look at where we are right now, from the $60 to the $90 area. They report earnings tomorrow. Now, for those of you that actually want to find value in this market and a stock that won't be impacted too much by tariffs, look at something like Evolution AB. Now, they were down 1.96% today, so significantly more than the market. They are in the smaller mid-cap region, but we definitely are starting to see a very solid base right here. They traded at great value. They're growing revenues at double-digit clips. I think the market has this pricing wrong. So if you are looking for a turnaround play, Evolution AB is definitely the way to go. If you guys are looking at any of the mega caps, I think Alphabet is the place to be. They report earnings later this week, and we definitely are setting up for us to move higher. It looks like Alphabet is forming a bottom here and looking to rally on the back of strong earnings. Relatively speaking, you're forming sort of like a wedge pattern, looking for some more upside. Maybe even we have broken above, and now we're just waiting for the earning catalyst. So those are three stocks I think you can definitely buy. We do know the ETFs, the S&P 500 and the NASDAQ 100. And then when it comes to some of these smaller cap names like the RTY, you need to just hold the line with them. Now, looking at gold, guys, gold, another all-time high, just keeps making highs. I think we're going to see 3,000 gold, especially if we see a continuation of the tariff situation and it is prolonged. Gold will do very, very well. With the sovereign wealth fund, I think Bitcoin should do very well. Still hasn't taken out its all-time highs yet, the 109, but we're seeing some very constructive price action and consolidation. And that's generally what happens in Bitcoin. Let's look at the last year, right? We see a move up, consolidation, a move up, consolidation. And that's exactly what we're doing right now. Consolidating, waiting for the next move onward and up. So that's the charts, guys. Take this opportunity to buy the dip. Fundamentals are strong. The macro is strong for now. And until that actually changes, you want to be long risk assets. Diving into sentiment, this is CNN's Fear and Greed Index. And right now, guys, neutral sentiment is driving the market. We have had a whipsaw of volatility. We've been in greed. We've been in fear. We've been on the precipice of extreme fear just in the last couple of weeks. Now we are back into the neutral territory. Now, I am recording this before the market opened, so we could actually be in the fear zone on the back of Trump's tariffs. We'll see how we go, but all in all, sentiment right now is in the neutral camp and probably on the precipice or closer towards the fear zone. We'll see what that looks like looking ahead for the rest of this week. Now, we've officially entered the month of February, and what are our expectations based on seasonality? Now, we're looking at the performance of the S&P 500 from January 31st to February 14th, so pretty much the first 2 weeks of February when the trailing 12 months is greater than 10%. Now, the S&P 500 is up about 24%. We have quite a huge pool of data, as you can see, and generally speaking, in the month of February, after a bullish year, we can see a 1.21% returns, 20 up years, 8 down years, and you see a very positive hit rate. So generally speaking, after a strong year, a strong January, February tends to be pretty strong as well. And this is largely constructed for equities simply on a seasonal basis. This is really just technicals. Looking at the fundamentals though, guys, we saw a huge uptick in earnings. Now, for those of you that didn't know, this was the estimate at the start of earnings season. Coming into last week, we were at about 10.3% in earnings growth. We are now at 11.5% after we had Apple, Meta, Tesla, and Microsoft all report earnings. They reported earnings and we're now sitting at 11.5% earnings growth, margins still unchanged, and 4.6% if we actually look at the revenue side. Look at the expectations coming into earnings season. We are absolutely smashing expectations with 75% of companies reporting above analyst expectations. And if you take out the dumpster fire that is energy, you actually see 14.8% mid-teens growth here for the S&P 500 in earnings growth, 5.2% revenue growth. Guys, you love to see that. And we've had 178 companies report. So yes, it is still a thin pool of data, but we have had some of the big market movers report report and things looking really, really good for Q4 earnings season so far. But that is earnings, and where does that leave us with valuation right now? And if we just look at the US market as a whole, the S&P 500 sits at a 22.8 PE ratio, and we are well above the historical average here of 17.3 and well above the average range. If you exclude big tech, things look a little bit cheaper, a little bit better, but still pricey nonetheless. And now the US market is really the only market that's kind of overvalued. From here on out, the rest of the world, especially internationally, looks reasonably priced. So if you are looking to value, look at the rest of the world, and you can see right here that Japan trades at 14.5 times, Europe at 13.7 times, the all country world, excluding the US, trades at 13.6 times, United Kingdom, China, they trade at about 10 and 11 times, closer to 12 times. So the rest of the world looking rather cheap, but you really do pay up for quality in these US markets. And, if you dive into the actual fundamentals, it really goes to show that the US market is actually not as expensive, especially when you adjust for quality metrics. Now, a big part of the reason why S&P 500 valuations are as high as they are right now has to do with the concentration in big tech. And with the S&P 500 and the NASDAQ 100 extremely concentrated to the top 10 names, and with where valuations are right now, what does that mean for returns in the short term? By short term, I mean in the next 12 months. And if we look at this chart here from Goldman Sachs, the level of concentration has no bearing in return for the next 12 months. There's simply no trend that you could depict from this. Normally you'd see something like this or something like that. There simply is no trend. In other words, concentration risk doesn't really mean anything in the market. What you really want to look at is the technical, the fundamental, and the macro. And right now, all those things are aligning up for equities to simply move higher. The current combination, guys, of macro conditions has generally been supportive for risk assets because we see earnings grow, margins expand, we're in a cutting cycle, we're on the cusp of deregulation. Yes, tariffs and Trump are a little bit of a risk, but that has never really derailed the market. And the current conditions we should see onward and upward price action in the S&P 500. And if we actually look at what we've done in the last 12 or so months, or at least since the first Fed rate cut, we've kind of followed the average market reaction. So what does this mean for us? It just simply means expect more of the same, onwards and upwards, but not without volatility. I don't think we're going to have such a linear return. I think we're going to see a lot of volatility along the way. And let's actually talk a bit about the macro. Now, the macro looking very good. We got the latest Q1 estimate for 2025 from the Fed's GDP now, and it's sitting at 2.9%. So growth for this quarter, it is still early, don't get me wrong, but looking very robust nonetheless. And again, well above the blue chip consensus. But however, if we look at Q4 Fed's GDP now, the blue chip consensus was correct, at least the top end of the range. So I would say between this and this, the truth is somewhere in the middle. Now, a big risk over the past weekend and into the rest of the weekend, probably for 2025, is simply tariffs. Donald Trump announced a 25% additional tariff on imports from Canada and Mexico and a 10% additional tariff on imports from China. Energy resources from Canada will only have a 10% tariff, and this was done to curb immigration as well as the supply of fentanyl into America. What Trump wants is Mexico, Canada, and China to start taking proactive measures to stop illegal immigration. So that way, the US is working on two fronts. Mexico and Canada is working on the northern and southern border. And then we have the US trying to stop the curb of illegal immigration and by extension, fentanyl, drugs, and all of that coming into America. So that's why he implemented those tariffs. We'll see how the market reacts over the course of this next week. Let's just not look at a one-day reaction. Let's look at the full week. But at the end of the day, guys, when we look at the economic impact, tariffs are inflationary. So this is PCE prices across 9 tariff-impacted categories. This is from February 2018 when Trump enacted his first trade war, and then PCE on all other goods that were tariff exempt. We saw PCE fall for these non-impacted goods, but what we saw with goods that did have tariffs on them, inflation or PCE did actually spike up in a very, very big way. So this is definitely going to be a risk. What we are going to see is probably the dollar rise and yields rise to combat this right here. And this is simply what a Trump presidency will bring. The For America agenda will probably mean slightly higher inflation, higher yields, and a stronger dollar. Now, looking ahead, if we again look back at what we did in 2015 to 2020 with Trump's first trade war, this is what Donald Trump threatened on tariffs, that this is what was implemented, at least for China. So we'll see if he rolls back these tariffs over the course of the next week, or if more tariffs come back. And then for Mexico, he said 25% tariffs, 0 tariffs were implemented, but that is a little bit different now. Mexico and Canada and China now have a 25% tariff pretty much across all goods except for resources, which is 10%, and then China's tariff is only 10%. Now, looking at earnings for the rest of the week, guys. Now, tomorrow, Tuesday, we have some big names in my portfolio. PayPal. We also have Spotify reporting, Pfizer, Regeneron, Pepsi, Race, Merck, Estee Lauder. These are all stocks on my watch list. Race and Estee Lauder all on my watch list. Also Apollo Global. So it's going to be a big Tuesday before the open. And then after the close, guys, we have AMD, Alphabet, Snap, Chipotle, Enphase, Amgen, EA, Lumen, who EA actually reported their earnings last week, preliminary earnings that were down 17%, remember. So we'll see what the actual earnings are. So a started Tuesday, and it all kicks off with PayPal, Spotify, and some of these other names. But I'm going to be paying close attention to every single name that reports, particularly Estee Lauder. I've been looking at getting into this name for a while now. I haven't pulled the trigger, but we'll see where it goes. And then looking at data for the rest of the week, tomorrow the big one's going to be JOLTS. The forecast is 7.8 million. We also want to look at the revisions, but this number right here is going to lead us into the non-farm number. So we get a good JOLTS print that could offset some of the volatility that'll come with the Trump tariff situation. If the JOLTS is bad, yeah, that's going to be even more volatility in the market. Nonetheless, this is what we are prepared for in 2025. Volatility is the name of the game. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.